It's time for Futures in Focus, and we're watching oil falling from a 2-month high as traders rein in their supply constraint worries. Brian Battle of Performance Trust Capital Partners joining us now from the CME. Oil was already down, Brian, and then just about 45 minutes ago or so, it took another sharp leg downward. What are you watching here? What's going on with oil?
Yeah, Julie, in context, remember 70, we've held 70, haven't been able to get through 70, but you have to look back in the graph. You go back to 2014 for oil to get through 70, and that's when we were coming down from the highs. So 70 is a really resistance level, and remember what's going on here in the southeast. We had this giant hurricane. Everybody thought it was going to be biblical. The pipeline was going to get shut down. The Continental Pipeline was going to get shut down. It seems like it's going to rain a lot. It's going to be horrible if you're in the Carolinas. No offense to anybody there, but the storms are downgraded, so the threat is coming down. We're down about 2%, up 4% for the past couple sessions, down 2% now because of it looks like the storm's not going to be as big a deal. So we're touching that technical 70 and just coming off.
Gotcha. It's also interesting that we're seeing oil down by so much when the dollar is also weak, right? That's been a bit unusual over the past 6 months. We've seen more of that inverse relationship come into play.
You're exactly right. There's a supply, demand, and the price of oil. So the two things that have been tormenting the price of oil is not supply. There's plenty of supply in the market. The U.S. just became the world's greatest oil pumping nation. And the Iranian supply, we're like, oh, we're worried about the Iranians. Well, that oil is going to get into the market either through Africa or Turkey or some other way. So demand is what it depends on. And so is there going to be demand? What has been also forestalling demand is the price of the dollar. The dollar's been rallying because, so it's all connected. You can't talk about the dollar without talking about the Federal Reserve. The Federal Reserve is raising interest rates, ergo making the dollar more expensive, which is also putting a damper on demand. So it's the dollar, and it's also some global fear trades. It's also taking some of the wind out of the sails on demand.
And we got CPI this morning, too, PPI yesterday, both of them coming in below estimates. I know you're watching that as well and how it informs what the Fed is going to be doing going forward.
Yeah, nothing in CPI or PPI that is going to change the Fed's idea. You know, actually, CPI came in a little lower than expected, but still within the range. It's still over 2%. The Federal Reserve is going to raise rates. They don't care, it seems, about any variable economics, certainly month to month, maybe year over year, but they've got to get their policy back, so they're going to raise rates. It would take a disaster in CPI, and a disaster in CPI meaning really low CPI for the Fed not to keep raising rates. So it looks like the dollar's going to keep getting stronger, you know, over the long term. Intraday, we're going to have bounces, but we're going to get a stronger dollar. The question is demand, and demand these days is driven by public policy. Is there going to be a policy error on trade? Is the White House going to make a mistake or push too far? And that's where we're all kind of waiting around to see what our policy is. Remember, we don't have good or bad trade policy. We don't know what it is yet. So that's why we're kind of stuck at bouncing around 70 to see if the White House is going to impinge global GDP by creating more demands and more tariff.
Right. So given all of that, it sounds like your bias would be a little bit more bearish. Am I interpreting that correctly? And if so, then how low could we be going?
Yeah, so that's a great question. So, yeah, I mean, it's hard to, it's like Yogi Berra says, it's hard to make predictions, especially about the future. So at 70, it looks like we're at the top of the range that we've been at for a long time. The things that are going to make it go down are all still in play. A more expensive dollar, higher interest rates in the U.S., and public policy that is fomented towards slowing global trade. How can we get above 70? Is if all this tariff stuff went away, and then, of course, we get started closer to the midterms, depending on who's in charge of Congress. That'll either going to be pro-growth, you know, low taxes, less regulation, or will there be a reversal or maybe even stasis for the next 2 years? So a lot of the things that we can't control are probably going to stay in place. So I would expect the oil prices to stay low because of it's not supply, it's demand, and demand we can't control until we get through some of these other things. Yeah.